Great. I think we have all our speakers on and we can start going. So welcome everyone. Thank you for joining this ESG research brainstorm session. It's actually climate risk brainstorm. So I am Mervyn Tang. I head ESG research at Fitch Ratings, the credit rating agency. We try to understand how different ESG issues lead to financial impact on credit. And with that whole, just going through and looking at this, there's so many research topics and ideas that you need to understand to be able to really quantify that link between climate change and financial impact. This session is really designed to be interactive. We want to get your research ideas. We'll be discussing a range of issues that are important for understanding climate risk and financial impact. And we have some fantastic speakers who will talk about these ideas on stage. So I'll get them to introduce themselves. Emily, would you want to start? Oh, Emily, your mic might need to be on.
Okay, we got the mic working. Hi, I'm Emily Chasen. I am a sustainable finance journalist. I've been writing about sustainable finance for the past 7 years, which is about very rare in journalism. I've worked at Reuters, the Wall Street Journal, at Bloomberg, and just written for financial markets about all these issues. So I think today I'm sort of the practitioner perspective where I've talked to lots of people who are practicing in the markets in climate finance and some of the issues and challenges they're confronting. So that's what I'll endeavor to talk about. And I just wanted to say sort of why I got into covering this, which I think is really interesting, is that I was an accounting reporter for 10 years and writing about corporate accounting and Financial Accounting Standards Board, and just met some CFOs. I helped launch CFO Journal at the Wall Street Journal. And the CFOs, some of them were saying, oh, climate change is a real risk I have to really incorporate in when I'm planning, when I'm like building a business, when I'm building a hotel. I need to know in 30 years whether sea level is going to wash it away or not. But that's not like, it wasn't an issue for every CFO. So that's why I started covering sustainable finance. And then I wanted to get into this thing of covering and saying, like, these are material risks that are happening today in the market. And that's sort of my perspective that's coming from, and that's sort of what we've been highlighting for the past few years. So that's me.
Great. And then Tracy and Johannes.
Hi, I'm Tracy Van Holt. I'm the Director of Academic Research at the Center for Sustainable Business at NYU Stern. I'm an interdisciplinary scholar. I started my research really working with people in forestry, fishers, hunters, people really that are at the beginning, a lot of the commodity chains, and businesses became the new actors in sustainability. And so that's what's led me to my research here. So I bring I would say the interdisciplinary perspective. Remote sensing, I use satellites in my work, interviews, ethnography, and learning about finance. So excited to be here.
Johannes.
So I'm Johannes Ströbel. I'm a finance professor at NYU Stern, and I've worked on climate finance related research topics for a number of years now. Spent a bunch of time trying to think about how to design optimal hedge portfolios against climate risk, have looked at climate risk in real estate markets, done a bunch of projects in that space. Also a little bit more from the theory side, how would you integrate climate risk in our asset pricing models, sort of the more standard models that we teach at least advanced undergraduates or PhD students. More recently, I've also spent a bit of time thinking about the policy implications. So as a member on the CFTC subcommittee on market-related climate risks, some of you might have seen the New York Times article last night. The report's going to come out at 10 this morning. So I'm kind of excited to see how some of this research that we're doing on the academic side actually helps inform some of the policy recommendations, and hopefully over the next few years, even some of the policies that will be implemented by financial regulators.
You can see we have a range of perspectives across academia, as well as just Emily, who has just met everyone in sustainable finance all over the world. So I want to make this session interactive, and the way we're going to do that is through the Q&A mechanism. So we'll start off with the polling question, which is structured around the 5 categories of climate-related issues that we'll cover today. The idea is to upvote your favorite topic or the topic you're most interested in. You can see if you click on Q&A, there'll be a little vote button on the left, and you can see, assessing and quantifying transition risk is currently the highest. Improving the impact of sustainable finance is the second. So for the audience, if you could please continue voting, and I see that the numbers are going up, that's fantastic. This is our way of gauging what's interesting to you. Now, over this session, we'll probably spend around 10 minutes on these individual categories. We might cut some depending on time, but the idea is, as we start talking about these categories, is for you to start putting research questions and ideas that you are interested in. So for climate change in financial theory, it could be, say, uncertainty, or it could be green tail risk or green swans. Whatever you want to do or you are currently researching on. There's 2 clearly very preferred topics right now. But the idea is, yes, if the more research you put in, and we'll start talking about the research ideas that get upvoted the most, and try and give our perspective on what academia or what practitioners have been already saying in this topic, as well as our personal views. So we have got a lot of votes, and it seems like the favorite right now is improving the impact of sustainable finance. So for this, we're really thinking about what are we doing? Are we doing it effectively? With all these green bonds, with ESG, are we actually improving climate change? Are we actually doing what we're saying doing, or are we just patting ourselves on our back, just doing a lot of marketing exercises? I think a lot of people I speak to who are skeptics or even proponents, advocates, have that question. Maybe starting with Emily, I know you're burning to answer that question when we were preparing this. What are your thoughts on this? Oh, and Patricia, could you start removing the quick Q&A?
Okay. Yeah, well, this is my favorite topic when we were talking about this, Mervyn. So you started with me and talking about the impact of sustainable finance and what we're really doing, because obviously ESG investing has grown really popular over the past few years. Probably about 30 trillion in assets incorporate ESG in some form. But when you look at that 30 trillion number and you break it down, you see that, maybe 15 trillion of it actually incorporates ESG. A lot of it is just sort of excluding things. So does excluding things create an impact in the world? Does divestment work? I think that's a really interesting topic for research. There's been some research I've seen come out around the benchmark effect and what happens when a lot of people hold a certain kind of stock and a lot of people don't hold a certain kind of stock. And then just thinking about impact, that's really sort of the holy grail in sustainable finance right now. The last 2 newsletters I've written have all been about, how do you prioritize solutions versus, just avoiding risk in your portfolio. And avoiding risk, obviously, in the past few months, we've seen with the pandemic, ESG portfolios have performed very, very well. ESG, they were bet on tech, they bet heavy on healthcare, all things that did really well in the pandemic. And it turned out that betting on climate change and worrying about that risk meant that you were also worrying about sort of other systemic risks in the system. So ESG has performed really well. It's been very good at avoiding risk. But is that what you need to get to a green world? When you look at, how many companies are really aligned with the climate science, there's very few of them. People worry about green bubbles in stocks like Tesla, things like that, where they're just off the charts because there's not that many assets like that available to buy. So that's sort of what I'm hearing from practitioners.
Thanks, Emily. I would just add to the audience, please now start putting research ideas on this question, which is how do we improve sustainable does what we want it to do, which I imagine is to accelerate the low carbon transition and to have a positive sustainability impact. So please put your ideas in, and please upvote any ideas that you find interesting. Jumping back to the panel, Johannes, Tracy, any thoughts on this particular question, particularly on your different perspectives?
Yeah, so I think I think in some sense, one important way where you could improve the effectiveness of sustainable finance is almost just a marketing trick. When you talk to people these days, when I talk to people these days, a lot of ESG investing is about to some extent feeling good about yourself. It still is, right? You kind of give up a few percentage points or a few basis points of return in order to have a sort of a more ethically aligned portfolio. And I actually think that's the wrong way to think about sustainable finance. The way that I think about sustainable finance is more aligned to some of the things Emily hinted at, which is to say that it's a way to hedge yourself against realizations of this important risk in the economy, right? So if you think, what does sustainable finance mean? If you go for the most basic interpretation, say you have a portfolio where you overweight solar energy and you exclude coal, just as a most simple thing, as a thought experiment. When does that portfolio do well? Well, that portfolio does particularly well when climate change gets really bad. We're going to see a carbon tax that puts coal out of business, gives green energy, an advantage. And so, this portfolio, this tilt towards E on the ESG side, will provide you a hedge against these negative realizations of climate risk. Now, once we view it that way, I think it becomes a lot more palatable to investors who, have mandates which, require them to maximize some sort of, stock performance, and who struggle to deviate from that mandate and to struggle to include these sort of sustainable factors purely for ethical and so on reasons. What does that then do? I think even these tilts away from coal can potentially have large effects. Why? Because they affect the cost of capital across these sectors, right? So if you think about other sectors that have been shunned in the past, this comes back a little bit to Emily's point about, does even exclusion make a difference? If you look historically, what we in finance would call the sin stocks. So this would be tobacco, this would be guns and so on. These are stocks that have had really high rates of return, right? So if you're an investor in tobacco or guns, they outperform other sectors dramatically. Why? Because they have to do that in order to be held, which means they have a very high cost of capital. And so, if people, in some sense, my idea is, if you communicate to people that actually tilting towards, say, green energy is good for your portfolio, not because of high average expected return, but because of this covariance property. It hedges you against these realizations of this big risk, which is bad. We're going to see even more flows into those trades, which is going to, increase the cost of capital for, say, the coal firms, going to reduce the cost of capital for the green sustainable firms, and through that channel actually might affect the climate path itself. So that remarketing, telling people to think about covariance rather than just expected return, and then getting more flows into that, might actually do something good.
Jump in there. Well, in terms of performance, I'm really interested in, is it actually making an impact on the ground? And I think there are a couple things that have to happen. One, we don't know where a lot of companies are operating. They don't even know where the extent of their supply chains and where they are located. So I think we need to do a better job of knowing where companies are actually working and where their operations are. It's not that information isn't readily and easily available. Two, the ESG measures, as we know, there are many different ESG measures and data providers. And coming from my background in ecology, I would say that they're very simplistic. I mean, of course, you need to aggregate things across, but I do think we need to go deeper in some of these ESG measures, specifically on the climate side. And just echoing, what I heard from Emily and Johanna is understanding the systemic risk across sectors and across portfolios. But really, unless we know where companies are operating, we're not really going to be able to measure the performance so well. And I see we have a ton of questions on the chat, Mervyn.
We do, and we should start covering them. And I think the top one by far is formulating global standards for ESG disclosure across sectors. We hear a lot in terms of panels and conferences, and related to what you're talking about. I guess, panelists, what are your views about how important global standards are? Or are we trying to standardize something that really can't be easily standardized?
Oh, I have so much to say about this because I was an accounting reporter for a decade, just covering financial accounting, right? And that's how I met people at the Sustainability Accounting Standards Board, and that's how I got into covering the space really early on. And what's interesting about that is that when you look at corporations, right, so much of their value today is intangible, right? And so much is based in brand equity. So, like, are these intangible issues increasingly important? Yes, for sure. Disclosure on them is generally terrible. It's getting better. I just did a story a few weeks ago with the head of the Sustainability Accounting Standards Board, and she said the number of companies using SASB standards to report are now up to 279, up from like 118 last year. So that is a very marked increase. But if I don't meet that many people who have been like me, who have tried to go through all the sustainability reports and actually use the information from them. They're very hard to compare. They're not very time sensitive. The data is very hard to manage. It's not comparable year to year. You sometimes don't know if people use the same metrics to calculate their emissions in one year as they did in another year. So there's lots of differences, but I've heard from investors that they say, okay, well, if you think about regular financial reporting, you think about earnings quality, you get, it's probably 85% effective. Like, you think earnings quality is pretty good and people are reporting pretty fairly. But when you think about sustainability data, it's probably only 10%, right? So it's like the Wild West of data. So global standards would be really helpful. It's just a long way to go. And the process that companies seem to go through for disclosure takes so long that it seems like we might not be able to get to the solutions we need if you focus too much on disclosure. So those are all the issues I'm hearing from practitioners, and I'd love to hear the more academic perspectives on it.
Yeah, so my sense is that, in order to, to direct more credible capital in this direction, you need better measurement, right? So I think we all agree on that. And so then the question is how you get there. And I think there's two elements here. One of them is the baseline disclosure of characteristics at the firm level. And then the next question is, how these sort of firm level metrics are then aggregated up to generate these ESG scores. So I think on the first one, yes, global standards would obviously be great. So what are the impediments? I think one impediment right now is that there aren't global requirements to disclose. And I think this is where we're going to see a lot of change, right? So I think more and more financial regulators, wouldn't surprise me if the SEC over the next 5 or 10 years required firms to disclose some aspects related to ESG with the same, with the same sort of same force of the law, force of the regulation as they currently do on the financial side. And I think that's going to force a lot of firms to clean up their act. My sense is a lot of ESG reporting wasn't done out of the investor relations team. It was done out of some sort of, sustainability feel-good team part of the company. And as a result, there weren't sort of standards. It was just, how can we make ourselves look as good as possible? And that gets you this patchwork of numbers then that don't work. Now, not everything can be quantified, but I think understanding things like carbon dioxide emissions and so on is something where I see some scope for standardization, but it won't happen until a regulator comes in and requires it, someone like the SEC. But again, I'm actually pretty optimistic that we're going to see that over the next few years. The second question then is, is every investor going to be able to take these thousands of numbers and trying, and right now we're relying on, companies, rating companies, other data providers to take these baseline numbers and aggregate them up and give us a sort of an E-score or a climate score for each company. And I think there, I think we can make much faster progress. And the big problem there right now, my sense is that a lot of the companies try to market their algorithm to some sort of, magic, proprietary super algorithm, where in the end, it's just a very simple regression. And, the downside is it just becomes an enormous big black box where no one knows what's going in. And as a result, you don't trust it. I've worked with E-scores from across a number of companies. Some of the things Emily mentioned are just entirely true, right? The correlations across providers are low. They have, the quantitative numbers have no meaning across time. So it's very hard to use this into portfolio construction and so on. And there's almost no back testing of this. You struggle, even when you try hard and you struggle to find anyone at the company who's actually willing or able to explain to you what goes into the construction of the various E-scores. They seem to weight different categories, which, you know, to an outsider look obviously very different equally. So you have this thing where like your CO2 emissions are weighted in exactly the same way as like some obscure wastewater treatment plan that your board once signed off on. So I think there I think the data quality is actually pretty poor, and it's hidden under the like, well, here's an e-score, I can just run with it. Now, if all you're going to do is, you know, you're Vanguard and you're putting together a green portfolio, you might not care all that much what goes in it, as long as you can say, well, we take the e-score from this provider or that provider, and that's what we're going to do. And, you know, and it becomes the marketing side. This becomes much more relevant when you're actually using this to, you know, when you're a hedge fund and you're trying to use this performance. So when I talk to people at hedge funds, they don't really use the numbers provided by the commercial data providers. If they're going to trade on it, they're going to build their own. Right? Why? Because we don't trust the black box. We don't really know what goes in, and we really don't trust the algorithm. So my sense here is, you know, what's going to be important is not just a disclosure by the company, but, you know, people like Fitch, S&P, you know, Moody's, and this, you know, in order to make these numbers useful for end users, transparency is the key. And I think people will value transparency much more than the willingness to pay a slight premium for some, you know, for some sort of bamboozling proprietary machine learning algorithm, you know, where sure, these are all fancy words and it allows you to charge me a slight premium, because if you open the black box, you realize it's, you know, it's actually a fairly simple aggregation of these scores. But I think without that, it's going to be hard to get the trust of the quantitative community, i.e. the people that don't just do it to feel good, but the people that actually, you know, want to figure out what the effect on performance is.
So I just have a little bit to add on this. So we've been actually speaking with active asset managers to understand how they are innovating in terms of sustainability finance. And I just want to point out that we could probably learn a lot. There is definitely variation in asset managers and how they're using the ESG data. So some, you know, might just take whatever's off the shelf and use it. Others are going to build their own models. Still others might have proprietary models within their organization. And I think it's that level of understanding how, where is the innovation? And I think there are a lot of different opportunities to learn from the experts there, how they're beginning to integrate this information and maybe have conversations with them across those ESG data providers. So it's not necessarily only about the data, it's about the model as well that they use. And I think that's an area of innovation.
Funny when people talk about innovation. Oh, sorry, Emily, please.
Oh, it's okay. I wanted to follow up on some of the things Johannes is saying, because it made me think that there are actually some areas where you get better reported data than others, and it would be good to highlight a little bit about that, because I've been looking for a while across markets, you know, where do companies report information that is actually comparable. I always thought the most progress in sustainable finance would happen on women on boards, because it is the clearest data we have in sustainability. And you actually have seen quite a lot of progress on that, investors acting really quickly because they have the data and they understand. So that's really interesting. Other places where there is kind of clearer data like that is the carbon emissions data is increasingly getting better, even though almost no company uses Scope 3. And then the other area is actually carbon pricing and having an internal carbon price. I think that's a really interesting area for disclosure to watch, because you can see how realistic a company thinks about climate change that way.
So going into the questions, there seems to be a competition for second place, with Rajiv from India's question on how can fiscal tax incentives to sustainable finance offset the cost of correcting ESG imbalances due to the lack of sustainable finance? I think this is a really interesting one, given we talked about some of the issues with the underlying sustainable finance infrastructure and the lack of disclosure, but at the same time, we're seeing demand to push for incentives. And I think, Emily, we talked about central banks before, and if they start putting themselves into the sustainable finance market, you start creating these incentives. And how does the infrastructure able to, I guess, correctly and efficiently use fiscal or tax incentives to get to our goals? Emily, Johannes, feel free. Tracy, please throw in your thoughts.
I mean, look, I think to me, as an economist, it's a very straightforward thing. It's that, you know, you need a global price on carbon or an economy-wide price on carbon. It's as simple as that, right? You put that in, you're going to get what Emily says, that every firm will have not their own internal price, but every project will have to figure out how much, you know, that element costs, right? You know, we have this simple framework of externalities, right? And what's nice about that, I think, is that you have, you know, that it's a corrective price that brings us back towards a more efficient equilibrium, right? Or quite often when we think about fiscal tax incentives, you know, we think about subsidizing these hugely inefficient industries to get them off the ground and so on. You know, you throw in a lot of money in the hope that some, you know, some sort of green energy, etc., will grow. And I think, you know, it's very, you know, there's a lot of good arguments why, you know, that's not desirable, this type of top-down industrial policy. You know, capital should flow to where it's most productive rather than where some sort of government decides it wants to direct its resources. I think there's good arguments, you know, why you don't want to do that. A price on carbon just brings you back and it internalizes the externality. Everybody that, you know, puts this cost on the rest of society has to pay the price. And that by itself, I think, will, you know, will redirect flows of capital quite substantially. So I think that by itself, which seems a, you know, the implementation is not immediately straightforward, right? You make it as a tax, do you do emissions trading? You know, how do you make it global? How do you avoid leakage? How do you, you know, how do you assign initial rights? Do you grandfather in? You know, there's a lot of implementation questions, but actually, you know, we have a lot of these schemes in Europe, actually in parts of the US and around the world. So I think we have a lot of experience in terms of how to try and get something like that off the ground. And that seems to me like, you know, 80% of the way there of where we need to be.
Yeah, I have so much to add to that. I love the how you phrased that, Johannes. That was great. I think when you look at incentives, right? Capitalism only works if you have good incentives, and you know that companies have been trying to adjust their incentives. Their executive compensation is a really interesting area to look at incentives in addition to fiscal and tax incentives, because there are increasingly companies that incorporate some sort of social or environmental incentive, and whether that actually works and does anything in executive pay is really going to be interesting to see. But yeah, capitalism works if the incentives are there, and you need capitalism to work faster. So in addition to having fiscal and tax incentives, they need to be speedier, because if you look at the Sustainable Development Goals, right, there's 40 trillion in investment needed to achieve the Sustainable Development Goals, maybe a rate of 3.3 trillion to 5 trillion a year needs to be deployed. And where is that money going to come from? Like, companies have that money, perhaps. Individual investors putting money into ESG assets, that's not actually really going to get to the solutions you need. So how do you correct that incentive system is definitely going to be a huge topic.
Great. With the conversation about carbon pricing, I think it would be a good time to move to the second very popular set of questions, which is how do we assess and quantify the impact of transition risk? Patricia, could you remove, I guess, maybe the first 5 Q&As in terms of what's been voted on so far? I see there was one question from the audience about a few people are having to leave the session, but they would like to have a summary of the session. So we will be doing that. So if you are interested in a summary of the discussion that takes place, please leave your email or mention on the chat that you would like a summary at the end, and we'll provide that for you. But once we've removed the first 5, please start putting your ideas from a research perspective on how you think we could better understand transition risk. And I think maybe the way to weave this for what Emily and Johannes was talking about is they talked about what would be the optimal carbon pricing policy, but what is the carbon policy we're actually likely to get? What is politically feasible? How do we actually think about transition risk in a world where there is all kinds of constraints? Let's start with that as a kind of opening debate. Emily, Johannes, Tracy? No one wants to throw the first one on that one?
For me, you know, a lot of the things on the transition risk side, you know, are things that have come, you know, and I think we can actually conceptually group this quite well with the physical climate risk bullet, which, you know, wasn't voted up, but I think it fits in quite nicely, which is, you know, physical climate risk in many ways is somewhat easier to measure, right? Because it's to a large extent, the parts of climate risk that are tied to location, right? And so a lot of the efforts on that is, you know, you want to in a somewhat sophisticated way, map out the locations of, say, firms' production, firms' supply chains, etc. Then you're going to have some sort of global climate model that you put on top, where we're going to have higher wildfire risk, where we're going to have higher flooding risk. You throw them together and you get some sort of company score. I think on the transition risk side, it's more tricky. And I actually think that what some of the E part of ESG scores are trying to achieve is not that dissimilar to the transition risk classification. And then why? Because again, my sense is the first order transition risk is going to be a price on carbon. There's a lot of other possible regulations which are along the transition, but that's going to be the big one. That's what, if you're an Exxon or a ConocoPhillips or someone like that, that's what you worry about. That's what's going to leave you with your stranded assets, and so on. And so trying to figure out then who would benefit and who would lose when you have this global price on carbon or economy-wide price on carbon. It's going to be very closely related to how much CO2 you produce, either directly or through your supply chain, and that is what talking about disclosure early on is probably one of the areas where disclosure is already pretty good, and it is sort of conceptually aligned with some of the subcategories of many E-scores of what they're trying to capture. So I actually think there's lots and lots of directions to go. And when you look at E-scores, they have 40 different subcategories. My sense is the top 1 or 2 will make up 80 or 90% of where the action is from an economic perspective. And so so I'm actually pretty hopeful that with better disclosure, primarily on the carbon side, we'll actually be able to get quite a long way there.
Great, thanks, Simon. Tracy, go ahead.
No, Emily, go ahead. It looks like you were going to say something.
Go ahead, Tracy. Your turn.
I'm good on this one. Go ahead.
Okay. So transition risk, right? This is definitely a big topic for us. Where I've just been at Bloomberg for 4 years, where we were talking about the TCFD and scenario planning and all of that. So transition risk, I think, is really, you have to ask yourself, what does the transition look like? There was a great paper that came out from the Principles of Responsible Investment, I think last year, called the Inevitable Policy Response, and where these policy risks are going to come, because if the world gets unstable enough, eventually there will be policy choices that will crash into the financial markets. And there are places that's showing up today that is maybe even an odd place. Like if you look at carbon pricing that we're talking about already, apparently the biggest carbon price in the world before the pandemic was on like Uber rides in London, where there was a carbon tax in London and you had to pay a little bit more on the Uber ride. But if you translate that to carbon per ton, it's probably like $1,000 a ton of carbon, right? And that's probably the world's best carbon pricing mechanism yet. So there's lots of ways for that to show up in a transition risk that maybe people haven't thought through. And another report I want to point to also is the UN Special Rapporteur on Human Rights last year put out a report on climate apartheid, and how the transition is going to create like a totally different system for people with wealth and people that are in poverty. And you need to be super aware of that, because capitalism breaks down a lot when there's inequality and risk in the system. And that is something that will get in the way of just a clear energy transition. So you can think about energy, you can think about coal phase outs, you can think about, agriculture and trying to re-incentivize that so that you use more sustainable systems that don't turn agriculture into a net absorber of carbon as opposed to an emitter. There's lots of opportunity and cost there, but you really have to think about the things that get in the way of it as well.
Another aspect that I've kind of been thinking about a little on this transition risk side, I think up to now, the way I was thinking about it largely was, what is the current business model of a firm and how is that business model exposed to, say, a carbon tax or some of these other policies? I actually think a second aspect that's a little bit harder to grasp is the ability of firms to change their business models. And I think it's both an ability and a willingness of firms to change their business models. So I actually think things like management quality, play a big role in the transition risk. There's going to be some firms that are going to, for whatever reason, just stick to their guns, and when that inevitable regulatory response comes, they're going to be unprepared. And then there's going to be other firms, we've seen it in the energy sector, BP rebranding as Beyond Petroleum, and there are these firms that we think as sort of very exposed might actually themselves act to reduce their exposure to the regulatory response, both because the management is smart or because investors are pushing them in that direction. And so that's obviously much, much harder to quantify. It's easier to say, what's your current business model look like and how's that exposed? It's much harder to predict what your future business models are. But I do think different management teams, I trust them differentially in their ability and their willingness to sort of, make drastic deviations from current business models in order to respond to this. And I think that's something we should think about, at least when we're investing, and trying to figure out who's exposed and who's.
Yeah, a follow-on issue is that thinking about how investors are comfortable with scenario analysis and are comfortable with using probabilities for things that could happen. There's a question here about credit ratings, and I'm interested to hear Mervyn talk about this, but I did write a story a while ago about credit ratings, and after Hurricane Maria hit Puerto Rico, because Puerto Rico is in the Caribbean. It's at very high risk for environmental hurricanes and storms, and it has power plants that are just really close to the ocean, right? So there was quite a lot you could have done to sort of predict and say, well, in the event of a hurricane, this is what could happen to Puerto Rico. It's a very likely event there, and but that wasn't, if you looked at the credit ratings before Hurricane Maria, it wasn't really in there. Like environmental risks were not mentioned much at all. But then after the hurricane, every single rating said, oh, because of the hurricane, we're downgrading the environmental risk of this company, or we're, because of the hurricane, we're changing our outlook. So I think that's a really interesting scenario where it's just how do investors use this information and how do they think about that? There's a company I think about a lot. I think it's really based in Japan and has its operations in the US too. And they put different scenarios for every price of the yen and say, if the yen trades in this range, then this is what our results are going to be. And if it's in this range, this is what our results are going to be. And seeing that kind of analysis applied to climate and environmental issues, I think is going to be an area to watch.
It's an excellent point, because otherwise, we're always just predicting on the past. All the models are based on the past, and as we know, there's a lot of uncertainty in the future. So we're going to get to hear from you, Mervyn, about the credit ratings.
Of course, and I think it weaves in quite nicely to that one of the questions on stress scenario analysis. And it's interesting because Emily, you mentioned the probability, and I think a lot of people have struggled with probabilities. I think as you mentioned the Puerto Rico incident, I think in hindsight it now becomes much clearer, and I think we can do a lot better in terms of forward looking and trying to understand different climate models to really think about these risks in the time horizons that are materializing. I think one of the things that has come up, and we wrote a piece on the climate impact to sovereigns, and we made the argument that a lot of these issues, even though we're getting a better sense of how they might evolve, the timeline is still very unclear. And when you start to quantify, say, the base case, it becomes very difficult, especially with the amount of uncertainty. Because even with physical risks, we can look back and let's look at how a hurricane might have impacted an entity, but actually in a world where the sea level is higher, the temperatures are generally higher, and there's a hurricane, what does that multiplicative effect look like? And I think we kind of went into, so we're jumping onto a few of these categories now, but I think there is a question of how well financial theory as it is now, how well can it capture something where there's so much uncertainty and there's not a clear base case? Johannes, I know you've done also a lot of work on long-term discount rates, which I think brings into that question as well of how do we discount and put into a DCF model something that is sort of coming, but you don't know exactly when and how much.
I think there's sort of two aspects here, right? One of them is the uncertainty element. And I think my sense is that our models are relatively good at dealing with uncertainty that we can quantify. and they're not very good at dealing with uncertainty, where there's uncertainty about the amount of uncertainty we have, right? You know, so I mean, almost all models that we have, that we teach, you know, once you go beyond sort of, you know, first MBA class you take, you know, they do have some element of uncertainty in them. And I think, you know, not just uncertainty in terms of variance, but also uncertainty in terms of the covariances, which, you know, drive a lot of the asset prices. So that's kind of one element. And I think, you know, the uncertainties that are hard to quantify, I think, are they're very tricky. There's a bunch of work that I've started to do, where we're, you know, and I think this kind of comes in, what are the uncertainties we're dealing with here? Well, they really come from the physical side, right? So they're somewhat different to the types of uncertainties that, you know, people in finance are used to, because people in finance, you know, usually deal with, you know, uncertainty by looking in the past, seeing how frequently events occurred, you know, and so on. And now you have some sort of very low probability events, which are, you know, hard to quantify, you know, even with hundreds of years of data. But in principle, the idea is we have some sort of stable system, and we're trying to deal with uncertainty by using past data. Here, the issue is we know it's coming, and we know it hasn't happened in the past. And so looking at sort of, you know, using data to quantify uncertainty isn't going to work. And so then what's the approach? Well, the approach has to be to try and build some sort of models of physical climate change into our asset pricing models, into our valuation models. And that's really difficult because, you know, first of all, interdisciplinary work is hard, so Tracy can talk about that. You know, the sort of the state-of-the-art climate model that the physicists built, you know, need supercomputers to process, and you know, and they're just, you know, they take away all the degrees of freedom before you even think about money and cash flows and so on. So you're necessarily going to have to abstract from almost everything that the physicists work on to sort of, you know, slim it down, to bring it down to something where you can then layer on, you know, what sort of the finance tells you. And so then the question is, what do you abstract from? You know, what are the essential parts? What are the unessential parts? And that's very hard judgments for, you know, say me as a finance economist to make, because I don't really understand the physics models as well as I would want to. And so I think interdisciplinary work here is going to be important. I know a lot of hedge funds, a lot of insurance company, reinsurers are, you know, working with these large interdisciplinary teams. And I think on the uncertainty side, that really has to be the case, and everyone has to give. The physicists are not going to be happy with our climate model that I'm going to build into my asset pricing. And actually, you know, as sort of a quant asset pricer isn't going to be happy with the asset pricing part of things, just because I'm going to ignore lots of other risk factors and so on, to, you know, to get something that's vaguely tractable. I think we're making progress. I think it's a long way to go. The other part you mentioned, which is, you know, let's put away uncertainty. Let's assume we knew exactly what climate damages were going to be 80 years from now. That I can give you the exact dollar number. What's the present discounted value of that even? You know, and you say, well, you know, what's the discount rate? And I think the answer generally is we don't really know. Why? Well, because we don't really, you know, what do you need to get an 80-year discount rate? Well, you'd want to go to some market and see an 80-year zero coupon bond trade, right? You look at what the price of that is, you know, uncertainty gives you a discount rate. Well, we don't really have those, right? In the US, you know, the zero curve maybe goes out 20, 25 years with some assumptions. You know, some countries, maybe you have 50-year, UK has some 50-year bonds, but you don't really have, you know, many finite maturity, but very long run assets. And so what we did in our work is we looked at real estate markets. And real estate markets in a bunch of countries, including the UK, Singapore, a lot of sort of, you know, British law countries, have this feature that, you know, you can buy the same property in one of two types. You can buy it as a freehold, which basically means you own it forever, or you can buy it as a leasehold, which means you say you own it for 100 years, and then it goes back to the original owner. And so when you see the same property trade under these two contracts, the price difference between them tells you the present discounted value today of owning the property in 100 years, right? And is therefore informative about discount rates over the next 100 years. And you can, you know, you can see 100-year, 150, 200. So it allows you, at least for real estate, to trace out the discount rate curve all the way up to 1,000 years. And so we find long-run discount rates to be really low. And this is something you see in other asset classes too. At the very short end, you see that discount rates for, you know, the next 1, 2, 3 year cash flows are much higher than the discount rates for the very far long cash flows. For example, you see, you know, dividend strips, have a much higher rate of return than the average rate of return on the underlying equity, which again suggests that the short-run cash flows get discounted at a higher rate than the long-run cash flows. So you see these declining discount rate curves, which means that people actually care a lot about what happens 100 years from now. And sometimes not surprising, right? We're having this discussion, we worry about climate change. If you discounted 100 years out at the average rate of return to capital, it would have a 0 present discounted value. No one would care about it. Yet, when I ask you, how much more would you be willing to own this house forever rather than owning it for 100 years? People say, yeah, I'm probably somewhere between 15 and 20% premium I'm willing to pay to own it forever, to be able to pass it on to my kids, then I'm willing to pay, to just have it for the next 100 years. And so that, 20% price difference tells you, we back it out. We get a precise number, 2.6%. There's obviously standard errors around that. But that 2.6% on a risky asset kind of gives you an upper bound on what the discount rate should be for investments in climate mitigation, and actually highlights why there is a lot of value in doing it, and why we're having this discussion, which is kind of not what you would expect if you just took it's actually, people in environmental economics for many years said, well, what we have to do is we have to do an opportunity cost approach. I can either invest in climate change abatement or invest in the stock market. The stock market returns me 6%, so that has to be my discount rate on the climate abatement. Well, then I invest, and something 100 years out is 0 present value. And so the environmental economists were sort of frustrated with that, because they wanted to do something about it, but all the models suggest that they shouldn't. And I think our idea of saying there's a flat term structure of discount rates is just wrong. It's empirically declining. In real estate markets, you have the ability to trace them out 100 years, and so you want to use much lower discount rates for far out events than for nearby events. Now, there's a lot of discussion, and I don't think we have time today about why that is the case, but empirically that is a fact. And I think it rationalizes why, people's intuition, I really care about what the world looks like 50 or 100 years from now, kind of conflicts with your basic DCF model.
Really quick response to that, because it's fascinating, but people are saying all the time now, is a 30-year mortgage like one of the real simple financial assets that we use all the time? Is that a real thing in places like Miami or Louisiana? Why do we still have that? So there's lots of questions about that. And I think I love that mutual fund line, that like past results are not indicative of future results, because that's happening all the time now. And that's sort of what we have to think about as the base case.
Yeah.
There's an interesting one that came in, and I think given some of Tracy and Johannes's research focus, so this is from Hugh at UNDRR, which is how to ensure investments reduce disaster climate risk to the communities and ecosystem where the investment is made, rather than focus on the risk to the investor alone. I'm going to flip this a little bit and kind of link it back to the uncertainty, because I find in a lot of financial firms, we want to simplify the quantification of a lot of these risks. So it's here's the carbon intensity number, here's your transition risk, here's your exposure in terms of geographical locations for your buildings, that's your flood or climate risk. But to what extent do you think with climate risk is the potential impact on, say, communities and how society operates potentially leads to, say, migration flows, social unrest, civil unrest, and does it become really just this big macro system effect, as opposed to what financial institutions are trying to do, which is to nitpick on the individual exposures of assets? Let's open that floor.
I just point everybody to Jeremy Grantham and the Grantham Institute and what they're doing, because they focus a lot on migration and the human impacts of climate change, and what will happen there and what the scenarios are for that. He's kind of a hedge fund manager, but definitely worth seeing how he's mapped out those scenarios.
Great.
Yeah, just jumping in over there. I mean, I think for companies, we do need to look at probably broader risks, and we do need to know where they're operating. But I do think that there are certain zones or areas where, if you just think of, I'm just thinking of a commodity like vanilla. There's a certain part. There's only a few locations in the world where it's concentrated and grown, or coffee or chocolate, just thinking of those particular commodities. And so I I think we have to think regionally in terms of some of the impacts. Otherwise, it might be too, nitpicky, as you say, like we need to move the needle somewhere, but we do need to understand we do need to be able to connect, these major trends like deforestation associated with commodities like palm oil, for example, or, cattle and deforestation. And I think that that's an area that's ripe for connecting it together with climate change and deforestation and commodities seems like a great area to begin, because you have the location of where those commodities are located, and you could see a lot of information on satellite images. I think there's beginning to be people tracing this, but I think part of what Johanna said about the interdisciplinarity is challenging in academia, because as you know, anything that's interdisciplinary, then you can't publish in the top tier journals. And I think we need to develop some project that's like for Nature or something really, like a high level interdisciplinary journal to kind of move the needle forward here. Otherwise, we're going to be not, there's trade-offs, right, in interdisciplinarity that we need to be able to address. Commodities, I would say, is a great way to begin to tackle some of these.
Yeah, I think it's actually a great question, because in the end, from a social perspective, these sort of final communities are, really important as one of the main things we care about. I'm skeptical that it's going to be very effective to put those communities in some sense into the objective function of the investors, for the same reason that we're then back to sustainable finance, sustainable investment being about doing good rather than sort of doing right by your investors. And why everybody wants to do good, again, lots of mandates don't allow you to do something purely because it's the right thing to do. It's just illegal. And even then, people respond to their own career incentives and so on. So I suspect if the push to helping the final community comes primarily from going to investors and saying you have to make sure the final communities are well off, I don't think that works. So I want to come back to this first point I made, which is I think there is a great and right way to think about some of these green investments as being doing good by your investors, or if you're an asset owner, doing the right thing for you as as sort of maximizing the overall pie, because they help you. Those are investments that are going to do very well as the climate keeps deteriorating, as this inevitable policy response rolls down. And so my sense is that I'm much more optimistic that we're going to see companies change their behavior because of pressure by investors, when investors realize that these hedging properties are really sort of the best reason to short coal, and that will inevitably have downstream effects on those communities. It's going to be much more diffuse, and so this idea, how do you link the two? That's going to be very hard. But I do think that effect's going to come, and I think just from a purely, both Emily and Tracy talked about how this needs to come fast. And I just don't think we're going to get to behavioral change by appealing to people feeling good about, some sort of group of, some sort of,
I'm going
abstract
to
group
just
of
jump in
people.
there for 1 second, because I do think that there is an example where human rights abuses, I would say 10 years ago in supply chains, were not really on the radar, even though they're rampant. They're still there in supply chains, but it's no longer socially acceptable. Like you do not want to have human rights abuses in your supply chain. There's many more well-being issues that aren't considered, but I think I've seen like the seafood industry shift from not even considering the workers and the people in the supply chains to actually having their branding centered on that. So it may be that we need to see more climate activities change for that shift, but we should be prepared for it. Mervyn, we're running out of time and they're going to cut us off. So I'm going to
very aware of that. Thank you, Tracy. So we'll use that to cut things off. But thank you for everyone who participated, including the speakers, as well as everyone who voted and gave research ideas. So I will be on a little bit later in the conference room if you want to discuss any more of these things in detail. I'm sorry because we haven't covered a lot of things that people have put, but I hope the conversation that we've had is interesting. As I mentioned, Tracy and I will gather some of these notes and of what people have put down and give a summary to anyone who wants who wants it. So thank you everyone for participating.
Thanks so much, everyone. I learned so much. Enjoyable.
Thanks, everybody. This is great.
I think we just get